Our next guest published a midterm election survival guide this morning laying out the different market scenarios. Let's bring in Lori Calvasina of RBC Capital Markets. She's the head of U.S. equity strategy. Lori, welcome back to the NASDAQ. Great to have you back here in person.
I know. Thanks for having me. It's great to be here.
So I just posed this question to traders. If we knew that the Republicans going to control Congress, as a result of the elections, then what would you do? I mean, you think that's the best case scenario for the S&P 500?
Yeah, look, I think that the idea that they're going to take back the House, I think that's pretty much baked into the market. I'm not saying it won't be a good thing. We won't have a few days of feeling good. It won't give us some stability. But I think if you really want a big kicker in the S&P, they need to take back the Senate as well. And I think you also need to watch the governor's races and see how they do there, because that's going to be viewed as a read-through into 2024 and how much momentum Republicans really have going into the presidential contest.
How strong of a catalyst do you think Republican-controlled Congress could be for equities into year-end? I mean, we are just posing the question of two-year, knowing that you're going to collect 4.7%, or S&P 500 on the back of the midterms if the Republicans sweep. What's your view? So
if you look back at 2002, and that's a year actually that 2022 looks a lot like, there's about a 76% correlation. It was another midterm year. You actually got a 20% bounce off of the lows ahead of the election into the time frame, say, around Thanksgiving. So we may be about kind of halfway done, given the move that we've already seen if you kind of go back to the recent high. So you could get a pretty substantial move from here. But just remember, back in 2002, you didn't hang on to it in December. Markets started trading down and went back and retested the low in March.
Lori, thanks so much for sharing your opinions with us and joining us here tonight. A quick question, just in terms of time frame of investment or how this might affect, are you looking for a possible Republican sweep to lead to a 3 or 6 month type of rally situation, or are we talking about a much more sustainable rally to markets?
I think it's a great question. If you go back and look at the history of midterm elections, you tend to get a bounce in the fourth quarter, and it does tend to bleed through into the following year. The problem with that is if you look in 3 of the past 4 years, you've gotten the 4Q bounce, but you've gotten flattish returns the following year. So I think it depends to some extent on how strong the fourth quarter move is. And to be honest, I'm starting to fade the idea that this is going to be a big impact on 2023, just because I don't think there are a lot of terribly interesting sector implications right now. I think this is a broad market feel-good trade, but outside of energy, I think I kind of struggle to come up with the sector beneficiaries.
But in terms of the overall market sort of impact, what are the major impacts you see on the market? Is it just the idea that taxes won't go higher or fiscal spending will remain in check?
I think those are definitely at play, but I actually did a survey of my analysts a few weeks ago and asked them about this issue, and most of them actually thought it didn't matter at all, but among those who did think that the election mattered, they all pointed to the regulatory backdrop, and they thought that would be the big feed through. Not that interesting to talk about on TV, but that's where their heads were at.
So it used to be the Republicans were the, close the purse, don't spend money. That seems to have changed over the last, I don't know how long. Do you think, though, it sounds like you think the market will react that way as if it's the old Republican?
I think so. I mean, when I talk to investors, I think they like the idea of gridlock. I think that they don't want any more kind of inflationary fiscal spending coming from the Democrats. I mean, it's really sort of the absence of doing anything more. And again, I think that regulatory backdrop is something people think about a lot. But I wouldn't discount this whole idea of just what does it mean for longer term, because I think that people are starting to think about, 2024, that's going to be here before we know it. That race is really going to go ahead and start heating up next year. So I think it's the longer term implications of what does this mean in the larger election cycle.
Lori, great to have you with us. Thanks for coming by.
Thanks for having me.
Lori Calvasina of RBC.
Yeah, I'd say more importantly, let's think about what does a stagflationary environment actually do to equity valuations? What does it do to the investment landscape? And I think that's probably the most important thing for 2023, no matter what happens, this week in the midterms, because we have a situation where none of us thought the Fed was going to be as hawkish as they were when we spoke last week. And then, so they could be wrong. They were wrong about, the pace of inflation rising. So I guess the point is, when I'm thinking about my portfolio, I'm thinking about different sectors, I'm thinking about, okay, what's going to do okay, at least maybe less bad, in an environment where maybe the 10-year is at 3.5% or something like that, and maybe growth is below the target rate. Maybe inflation is higher than where the Fed would like it to be, somewhere in the low single digits. And those are the sorts of stocks that I think are going to do well. I just don't think it's going to be a great return environment as a monolith investing in stocks in an environment where rates are going to be high and we're going to have increased inflationary pressures, especially versus what we had 3 years ago.
The 10-year being, though, at 3.5%.
Still high, but it's better than now, you know.
And it's good for your kids. I mean, it's good for kids.
Yeah, I think it should be good for Qs. Because like we talked about this over the last week, when we saw the 10-year go above 4%, what really started to get hit was a lot of names that don't have earnings, high valuation.
Right.
It was basically the theme of when things started to roll over in late 2021, when the Fed made it clear that they were going to battle inflation by raising interest rates.
Right. But Guy, I think that you have posited actually that 3.5% means the world is going pear-shaped, and so that's actually negative overall, more negative than positive.
Yeah, and I know you write notes down in your book, so you do recall, and I agree with that 100%. I mean, absolutely, if yields go lower, it's not because magically things got better. It's probably because the market's selling off and there's a flight to quality in the form of bonds, or people are coming to the realization that things are slowing down not only here, but globally, and the back end of the curve should be lower. So I understand the knee-jerk reaction might be higher for the market, but I think when people come to their senses, it'll be short-lived.